Okay, let's get started. Good morning. We're going to continue Chapter 6 today. We have just a few more slides, a little bit of Chapter 6 content. So last lecture, on Monday, we talked about different types of inventory costing methods, right? So what are the three types of costing methods that we're focusing on? What is the first one? LIFO is one of them, and FIFO and average costing, yes. So altogether we have three main ones, and there's also specific unit costing methods. What we're trying to do in Chapter 6 is to basically learn how to assign costs for when corporations starts to make sales to customers, and also at the end of the season we also want to estimate what is the part of inventory cost. So remember that inventory costing methods, all the differences there really is just to either assign costs from earlier inventory purchase transactions or from later ones, or an average of the two every time there's new purchase inventory transactions. So if different purchase transactions happen earlier, the unit cost is the same, then really using all three methods will give you the same result. So the only difference would occur if earlier you had a transaction that you purchased at, let's say, 50 cents for each bottle of Coke, later you have 51, later you have 52. If there's different purchase costs for the same type of item, that's the time point when the three inventory costing methods really matter. Okay, so this is just a way to do business in corporation for merchandisers, company specific, how they assign cost. So rather than keeping track of each and every item's original purchase batch or purchase transaction, they usually just assume customers either purchasing from earlier transaction inventory or later ones, or somewhere in the middle, an average of the two. Okay, so we actually already finished the topic of the different inventory costing methods. Here in the 5th and 6th section, we introduced a few more entries and inventory errors cases and how accountants usually deal with these inventory errors, okay, and adjustments. So at the end of Chapter 5, we talked about one adjusting entry. Remember that is different from service type of business. At the end of the season, regardless of whether the corporation is using perpetual system or a periodic system, at the end they always want to do a physical count of inventory, the dollar amount, the total value of inventory in the warehouse, and see if it matches with what's there in the system. So in the last part of Chapter 5, we talked about this journal entry. If there's a difference between, let's say, what's there in the system and what's there really in the warehouse, the difference is we would journalize an entry do an adjusting entry that looks like this for inventory differences between the system and actually the value in the warehouse. Now this is another adjusting entry. This is called lower of cost or market rule. So this entry here doesn't necessarily happen in each and every corporation, and doesn't necessarily happen in each and every season. But basically at the end of the year, before accountants issue yearly financial statements, they want to make sure that the inventory cost, meaning the original historical cost of inventory, is at a point that's lower than the current market price. Okay, so for example, if an item earlier was purchased at $10,000, usually for most of the products, for example, like daily living products, there's things that you see in grocery stores and regular retail stores. Usually the product, as time goes by, will slightly increase the price of this product. Okay, but in some cases, for example, high-tech based products, technology-based products like computers, notebook, iPad, iPhones, you can expect that after a few years, whatever was the high-tech product that you purchased earlier would not have the same value a few years later. Okay, so this journal entry would suit for some of those products or even other products. If, as time goes by, the retail price of those products gradually decrease and to a point that is lower than your original purchase cost, then accountants will have to journalize this entry to match up inventory's value with the current market price. We can also say this current replacement cost. Okay, Once again, if earlier a corporation purchasing a batch of products, let's say they're worth $10,000 in the beginning of this year, January 1st. Okay, now later on they definitely want to resell this product to their customer, and let's say they mark up the price that worth $20,000. So this was the retail price. This is the sales price that they can get from customer. This is the original purchase cost. Okay, you purchase something at $10,000, you sell it to your customer as $20,000. So let's say this was a box of iTouch or iPods. Later on, after 5 years, the current market price gradually decreases to a point that it reaches $12,000, and then later on perhaps $9,000. Let's say this was 3 years later. So once it reaches a point that is lower than your original purchase cost, you will have to reduce the inventory value by that $1,000 differences with this journal entry. Okay, so basically the concept here is that we want to exercise accounting conservatism principle. Remember in the beginning of the chapter we talked about 4 different principles. And accounting conservatism relates to estimating expenses and liability to the highest possible level, right? So the principle, the underlying core is that we want to measure up and make sure that inventory value is not overstated. Meaning that if the current replacement cost is only $9,000, you cannot represent $10,000 on balance sheet for this asset. If currently the market really already recognizes that the product is no longer worth that much, if it's only $9,000 or even lower than this, then we will adjust the differences between your original purchase cost and the current market price. Okay, so this is exercising the lower of cost or market rule. You'll be comparing at the end of the year for all your inventory, the original historical cost and its current market price. Usually market price will be higher than your original historical cost. But in some cases for some of the products, if their current value has decreased to a point that is lower than your original purchase price, then you capture the differences between the two and reduce inventory's value. Okay, so this entry here, the example is that earlier you purchased an item that worth, or a group of the same type of products that were $3,000. At the end of the year, currently the market price for this product decreased to $2,200. Okay, so now the difference is here. Usually the case, this will be lower than retail price, the market price of this. But if this is not the case, if it's the opposite, market price, you can't sell the product at $3,000 anymore because all your competitors are selling the product at $2,200. And you capture the differences here and reduce your inventory value by $800 to match with the current market price. Okay, so the replacement cost here is the current market value for that product. Right, so after this journal entry, if the original inventory value is $3,000 and you journalize this entry to reduce $800, so what you would see on balance sheet for this inventory account, I just snapshot the inventory account only, not the other asset account, you would only see $2,200 here. Okay, and this reduction from $3,000 to $2,200 is solely because of the market price has reduced to a point that's lower than the original purchase cost. Not because we sold out $800 worth of inventory. Okay, it's because of this adjustment, lower of cost or market rule. Yes, I just passed around 4 piles of practice questions to make sure you choose your own. Okay, you should have 4 from 4 lectures, 4 practice questions. Okay, so this journal entry here really looks exactly the same as Chapter 5's adjusting entry that we talked about. When we do a physical count of the actual inventory and see if it matches with what's the inventory level there on the system. These 2 entries look exactly the same, but it means different. Okay? But so for the problems that you see, if it tells you that this case here, if it tells you the current market price is different from your original historical cost, you would journalize this entry. But if it tells you that the current value in the warehouse is different from what's there in an online system, you would also journalize this entry. Okay, so these entries are, in a sense, they're both adjusting entries, adjusting inventory's value. The key point here is that we want to make sure corporations reflect inventory account that really matches with what they have there in the warehouse and the actual value. Okay, but they share the same entry. When you debit and credit, the accounts are the same. Just the values, how we take care of them, difference depends on problems. Differs depends on problem. Okay, other inventory cases, if there were some cases of inventory errors in the middle of either journalizing the entry or actually counting the inventory value, keep in mind that inventory affects not just the inventory asset account, but since it oftentimes goes hand in hand with cost of goods sold expense account, once there's an error in this entry, this affects both of these accounts and later on affects income statement's net income amount. Okay, so the next few slides is just talking about in case there's some of the errors, accountants not only need to adjust inventory value, but also cost of goods sold expense and possibly the entire income statement. Okay, so this is a case that, for example, if the inventory real value is $10,000, we accidentally misstated $5,000 more. So you have $15,000 here, $15,000 here for, if you overstated an inventory, for example, if you miscounted the ending inventory in the warehouse. In reality, there's $10,000 of inventory, but you counted it as $15,000. So in the case that you overstated the ending inventory value, remember that these two, either the inventory value is either in the warehouse or you recognize it as cost of goods sold. So if you overstated one, then at the same time when you journalize the entry, you also understated cost of goods sold expense. Okay, so these two effects here, because this inventory amount, if you have too much here, then at the same time you also recorded another part of cost of goods sold expense as understatement for that $5,000. And then expense, if the expense is understated, remember that expense is subtracted from revenues, then at the end your gross profit and net income would also be overstated by $5,000. Okay, so remember that last lecture we talked about that 773, the cost of goods available for sale. This part either becomes ending inventory that's in your warehouse or becomes cost of goods sold. Right? The total purchases of inventory, you either sell them partially, or if you didn't make sale to the customer, you kept them all together, and you would have 773. Once you start selling them, a part of it turns into cost of goods sold expense, and at the end you only have the remaining part for ending inventory. So if the remaining part of ending inventory is overstated by $5,000, then this part here at the same time will be understated by $5,000 because the total of these would always be the same amount, same purchase inventory, adding up all the purchase transactions of inventory. Okay, so this is what this table is trying to show. If ending inventory is overstated by $5,000, since all the entries related to inventory always goes hand in hand with cost of goods sold expense, cost of goods sold will be understated, and then since expense is understated, you would be subtracting too less from revenue account. You would have too much of gross profit and too much of ending net income on income statement. The tip to remember this really is that cost of goods sold expense always has the opposite understatement or overstatement effects compared to all the other three accounts. Ending inventory, gross profit, net income always has the same overstatement or understatement effect. Cost of goods sold has the opposite. So again, if you thought you had too much of inventory in the warehouse, and at the same time you also recognize that you sold less to customers, so cost of goods sold is understated. And then expense understated, then when you subtract expenses from revenue, you're subtracting two less. You should have subtracted $10,000, when in reality you only subtracted $5,000 if you understated $5,000. Okay, so then your income, profit will all be overstated at the same time. Now if we flip the case here, let's say ending inventory now is understated. So for example, this adjusting entry here, you should have recorded, again, $15,000. But now you understated the ending inventory by $5,000 or $1,200. Okay, so meaning that the dollar amount should have been more than this. Should have been $16,200, for example. If ending inventory part is understated, if you thought you had this amount, but you actually had more than this. So it's understated by $1,200, and cost of goods sold at the same time will be overstated. Okay, so those two accounts will always have the opposite effect, because altogether it forms cost of goods available for sale. So if you thought you kept more than the other accounts, you actually had less. If you thought you had understated ending inventory, then cost of goods sold, you have an overstatement. And then if expenses are overstated, then your income will be less than what you actually have. Net income, gross profit will have an understatement of the same dollar amount. So again, cost of goods sold expense is the only one that has the opposite direction compared to ending inventory, gross profit, and net income. Now, inventory and cost of goods sold, which one is permanent account, which one is temporary account? And the temporary account is the ones that we close out at the end of the season, the closing entries for. So ending inventory, which really is inventory account, cost of goods sold expense, which one will be closed out, which one stays in the business's financial statements and carries on? Expense. Expense and revenues will be closed out, right? Anything that you see on income statement, revenues, expenses, remember closing entries, those are the first two. Okay, what's kept in the business is really inventory from these. Okay, so the understatement and overstatement effect, since inventory is a permanent account, it carries on to following season. So if you had an error that occurred in ending inventory here, again, let's say the upper part mentions that it overstates by $5,000. This $15,000 overstatement of ending inventory would carry on to the following period's beginning inventory. Okay, because this is a permanent account, so anything that you see on balance sheet at this year end will become the beginning balance of next year. Right? And then you add on journal entries, post-entity accounts, summarize them. But if there's an error effect that happened this year at the end of counting these ending inventory, and if this is a wrong number, this wrong number also carries on to the following period, becomes a wrong number of beginning inventory. Okay, so just keep in mind that these inventory errors here, especially any error that occurs for permanent accounts this year, all carries on to the following year. Okay, so this is very important to know, meaning that at the end of the season, when the account is actually due the physical count of inventory, make sure that the transactions are captured correctly. Inventory is actually a very important account for merchandisers. Okay, so if beginning inventory is overstated, then at the end, this season's cost of goods sold expense, gross profit, these are also messed up. Okay, but in this case here, really the error effect only carries on to the following year. In the third year, if at the end you counted the ending inventory correct, if this is the correct amount, then the third year would not have the same effect carried over. Okay, so any error effect only affects the following season, the following year. When it reaches the third year, since only the permanent accounts ending inventory carries over, if this part is correct in the second year, then following the third year will have a correct balance.
It's always 3 years?
No, it's only actually 2 years.
Yeah, but third one shows the right one, right?
Third one shows the right one, yes. So you should say it's only 2 years, the effect. Okay. Unless this part is wrong. Unless this year account is messed up, the actual count of ending inventory for this season again. Usually at this point, they should be able to catch any error that happened before, because they will be able to match up if they did the right count at the end of the second year. But if this is messed up again, then of course the third year would also be affected in the beginning season. Okay, let's do a quick exercise on this. So it tells you this bakery reported sales revenue $52,000, cost of goods sold $22,000, and they ask you to compute the correct dollar amount of gross profit here. So here you see two cases. A states that the ending inventory you see here on the balance sheet, that's stated in this company's balance sheet, is overstated by $6,000. Second case, ending inventory is understated by $6,000. So this is the dollar amount that's reported in income statement. Sales revenue, cost of goods sold, and gross profit as of now. But under a situation of ending inventory, you know for a fact that it's overstated by $6,000, how would you change this dollar amount to make sure this is correct? How would you edit this? So think about the relationship between ending inventory and cost of goods sold. If that is overstated, what about this?
Understated.
If that is overstated, this is understated, right? So what will be the correct amount? If it's understated by $6,000 and this is $22,000, so meaning you have to add back that $6,000, right? Again, if ending inventory is overstated by $6,000, it has the opposite effect for cost of goods sold. Cost of goods sold you see right now will be understated by $6,000. So in order to correct this dollar amount, you would have to add $6,000, it becomes $28,000. Okay? So you would see at the same time, since this is corrected, being corrected, then this gross profit amount also will be adjusted. So gross profit amount earlier, we had an overstatement. Again, this would have the same effect as ending inventory. So this is overstated by $6,000, we subtract it by $6,000. Okay, what about B? B, ending inventory is understated by $6,000, meaning at the same time, cost of goods sold will be overstated by $6,000. So again, if we go back to the wrong information here, if you want to change this, if this is overstated by $22,000, then you want to subtract it to its correct amount by subtracting $6,000 so that it reaches $16,000, right? And then B, ending inventory is understated. At the same time, gross profit is also understated. So you add back that $6,000, $36,000. Okay, if this problem goes on to state even more detailed information, remember after gross profit, multi-step income statement, there's operating expenses, selling expenses, general expenses, and it also states up to the point of net income. And you also need to change net income's dollar amount. Okay, as I mentioned earlier, ending inventory, gross profit, net income has the same effect. So if gross profit is $30,000 here, You subtract 6,000. At the end, net income, you also need to subtract 6,000. Here, if ending inventory is understated by $6,000, you add the 6,000 back. For net income, you also need to add 6,000 back. Okay, gross profit and net income has the same effects direction. One is overstated, the other one is also overstated. Any questions so far? Okay, that's pretty much all of chapter 6. So the last part of this chapter, the estimation of gross profit method, I'm going to skip it for now. Okay, I want to move on to chapter 8. So this chapter, the most important thing to know is you have to know how to do the problems for FIFO, LIFO, average costing. Okay, you have to know what it means. You have to know how to apply it to problems. This week you have homework. Oh yes, by the way, homework is not due next Tuesday, and maybe due the following, after spring break. Okay, so you have 2 weeks to do the homework. Give you 8 problems for this homework, since you have 2 weeks. Right? So it's due March 26th instead of next week. Some of the problems you're given is FIFO, LIFO, average costing, how to assign the cost, how to calculate the balance for these inventory. You have to know, in case there's adjustments, what are the 2 adjusting entries for inventory. One is introduced in chapter 1, one is introduced just now in the beginning of this chapter, lower of cost or market. Okay, for ending inventory errors, in case there are some errors that you're specified to you in the problem, how do you make adjustments? As an accountant, how do you change the numbers and make sure that the numbers is correct? Okay, we're focusing on inventory here because for merchandiser's company, really that is the most important account. That turns into sales later on. Okay, and then sales together, you will have cost of goods sold expense reported. That determines what's the gross profit and net income for this company. Okay, so 5 and 6, the topics are all on inventory, introducing you another type of corporation other than service type of business. Okay, now in following chapters, we're focusing more on balance sheet accounts. Following chapters in 8 and 9, all on assets. 10, 11 on liabilities, and then the following chapters on equity. And then at the end, we talk about cash flow statement. Okay, 8 and 9, we're moving on to balance sheet accounts, some of the important issues that you need to know besides putting together a balance sheet. What are the detailed information in receivables account or long-term asset accounts? Okay, so this chapter 8 is all about receivables. Breaks down to accounts receivables, which should be pretty familiar by this account by now. Also notes receivables. Okay, we haven't talked a lot about this notes receivables. Hopefully after spring break we'll discuss some more details.
Chapter 7?
7 we're going to move it to the end, but if we don't have time, we're probably just going to mention a part of that. Okay, so chapter 7 is a little bit different from all the other chapters. It's about banking systems, okay, adjustments. If we have time, we'll come back to that chapter later. All right, accounts receivables, again, the definition here, you should know this by now. It's a promise to receive cash from customer. A promise from customer made to you because you provide a service or provide a sales to customer. All right, so this definition, we talked about this in chapter 2, chapter 3 already. The collection period for accounts receivable, generally speaking, is about a month or so. Okay, so the billing cycle starts with once you provide the service, provide the sales, the goods to customer, then you would also attach an invoice to them, stating the dollar amount that they owe you and also the dates that they need to pay back this money. Okay, so accounts receivable, basically again, is a promise of payment that you'll be receiving from customer and clients. Now, usually accounts receivable in the general ledger, you not only have this one account, you usually also have subsidiary accounts that state the specific client's name. Okay, so in the business, usually they have separate, think of it as small accounts receivable accounts under the general control account, the big accounts receivable. We usually separate different clients into the accounts receivables, just to control and make sure that which client has paid the money and which client is still pending the payment. Okay, those are the ones that we call subsidiary accounts receivables. So they're just like regular T accounts. It's just that we separate them based on clients, based on customer, in more detail, provides more detailed information. But at the end of the year, what you see on balance sheet will be a summary of those clients' account altogether. And so this chapter here, we're dealing a lot about the cases of if customer is not able to pay the money on time, we're not able to pay the money at all. Okay, so there's some cases that accounts receivable gives, basically has an advantage for customer because they could purchase the item even though they don't have cash on hand. This also allows corporation to make sales to some of the customers that do not have enough cash funds in hand. Okay, so this is a benefit for both parties in the beginning. But later on, once it passes the due date of customers' payment, accounts receivables payment, and then after constantly trying to reach the customer, after several attempts trying to ask them to make the payment, in cases that customer has a financial difficulty or just still, they have to delay the payment to later on, they just don't have the cash on hand, this chapter will dealing with some of the cases how to take care of those accounts. Okay, those are the ones that we call uncollectibles. Uncollectibles represents accounts receivables that has passed due and we're not able to collect on time or even at all later on. Perhaps they have some bankruptcy issue, financial difficulties issue, and how do we take care of these in journal entries? Okay, other than accounts receivables, there's also notes receivables. Okay, the only difference between this and accounts receivables really is the time frame and also interest that's involved. So notes receivable in a sense is more formal than accounts receivable because usually both parties would sign on a promissory note stating the date of this transaction, the dollar amount, and the specific interest rate that comes together with this transaction. So notes receivable definitely has interest rate involved, meaning later on you're not just collecting that $1,000, for example, that you borrow to the client. You're collecting $1,000 plus a certain amount of interest. So that depends on the corporation and the client's relationship. So it could be 2%, 3%, any percentage agreed between the two parties. Okay, so the principal amount is what we call the original amount, either the dollar amount that you borrow to the client or the dollar amount that relates to the product that you're selling to them. Principal amount plus interest together is the maturity value for notes. Okay, once again, if you make sales to customer, corporation, and you have customer, regardless of whether you borrow money to them or provide products, sales, let's say $1,000 worth of products, let's say this notes receivable worth 3 months, okay, and you apply 10% of interest to it. The 10% of interest is a yearly interest, so that $100 you would divide by 12 and then multiply by 3 months. This we'll talk about in more details later. So basically, whatever this interest is, let's say it's $33, and this interest rate together with that $1,000 would be paid by client to your company. Okay, this together, the principal amount plus interest together is what we call the maturity value. Maturity value of notes. So just like other type of assets, if an asset has a lifetime, if a note has a lifetime of any month within a year, below 12 months, then it's considered a current asset, current notes receivable. Or some companies will call it short-term notes. Okay, but if this note was signed off for clients, they have they could pay the money later, longer than a year. If the payment period is a year and a half, if it's longer than a year, then it's considered a long-term asset. Okay, long-term notes receivable. So that will be specified on the promissory note once this agreement is decided. You have the date, both parties, the dollar amount, the interest rate on a promissory note signed off. So if the note has, again, a lifetime shorter than a year, it's short-term, current notes. Longer than a year, long-term notes. Now The maturity date stated here basically is the due date of the note. Maturity date, on this date, the client and the customer will be paying the maturity value, interest plus principal amount. So this is the due date, which is specified on the note as well. Okay, going back to accounts receivables. Allowances method here to account for uncollectible. Here, the next few sections we're going to talk about for the cases that in order to avoid clients that they have late payments, or even if they have payments that they can't make at all, then what are the journal entries for us, for corporations' perspective, to journalize upfront for those cases? Okay, these few entries here is just a review of sales entries. You can see August 8th, this company made sales to Brown customer and Smith customer. Okay, so you see accounts receivables here for Brown and for Smith. The slash means the subsidiary accounts. Okay, accounts receivable slash something that means those dollar amounts goes into the subsidiary accounts, and later at the end of the year will be summarized together, thrown into accounts receivable general account. Okay, the ideal case is that once the accounts receivable is due, or even before it's due, remember Chapter 5 we talked about a lot of the credit terms. Sometimes companies will encourage customers to pay back the money beforehand, so they have a discount period. Ideally, you would like the client to pay back the money as early as possible. So usually this is the case from the majority of the customers. They'll be collecting the money on time by cash, reducing accounts receivables. Right? Now the benefit for, let me just skip the benefit here. So in case that some companies do not pay the money, we will want to do an allowance method just to avoid this case up front. So before we actually identify in this year's transaction what are the customers that haven't actually paid the money, before that actually happens, for corporations under GAAP, the generally accepted accounting principles, usually companies would have to estimate a percentage of uncollectibles up front before it actually happens. Okay, so this is what we call the allowance method, and this breaks down to the percent of sales method and also aging methods. Again, what we're trying to do here is to estimate a percentage based on historical experience, based on last year's experience, estimate a percentage of accounts receivables that company are not able to collect. Okay, this is what the allowance method means. So this is in line with the matching principle concept we covered in Chapter 3. Matching principle, we talked about estimating expenses and then subtracting it from revenues, which is how we get to net income, right? So this is one of the expense that company realizes as an expense of doing business by accounts receivable. But instead of just making sales by cash, they oftentimes offer customer a way to extend the payment date by accounts receivables, but there's a cost to doing business by this method. So the cost would be that it's risky in a sense. Some customer may not be able to pay the money at all later on. Okay, so the cost here is that some companies don't pay, results in uncollectible account expense, or we call this doubtful accounts expense, or bad debt expense. So all these terms are interchangeable terms that relates to uncollectible term. So the benefit here for making sales on account is that you have a wider customer group. You can make sales to customer even though they don't have cash on hand right now. The cost is that you may likely be having a delayed payment, okay? Or may not even be collecting a part of the payments that customer has actually incurred in sales. So there are two methods to account for these cases. For all the public traded companies, we'll be using this first one. And this is our main focus for this chapter as well. Allowance method. This is the most popular one. For mid-sized, small firms, if they're not publicly traded, they don't have stocks traded in the market, sometimes they would use direct write-off method. Okay, but the first one here is encouraged and is also regulated for all public traded companies, allowance method, meaning we do an estimation up front. Direct write-off, they wait until they know the exact customer who didn't pay the money, then they write off the accounts. Okay, for the first one here, allowance, we basically estimate a pool of potential uncollectibles. And again, our main focus is this allowance method. It's used for public traded companies, but today we'll also be going over a little bit of direct write-off, how it actually works. It's easier in a sense, but it's not in line with the matching principle. So we'll talk about this a little bit later. Okay, so allowance method again records uncollectible account expense in the same period of time of sales revenue. So what this means is that throughout the year, company will be making sales to customer on a daily basis. There's definitely will be hundreds and thousands of transactions. Before some of the transactions of accounts receivable becomes past due for the clients, before that actually happens, we'll be estimating a pool of uncollectibles and allowances for uncollectibles up front before we actually identify which are the customers that has the delayed payment. So this is what this allowance method means. And we'll make this estimation based on past experiences. Okay, so from last year's accounts and last year's information, you will be able to identify the percentage of accounts receivable over the entire pool that you didn't collect on time or you didn't collect at all. We will use that percentage, apply it to this year as well. Okay, so the two new accounts here introduced here is uncollectible expense account and also allowances for uncollectibles. So this allowance account is a measure of the part of the accounts receivables that a company is not collecting. It's a contra asset account to accounts receivable. Meaning at the end on balance sheet, it will be deducted from accounts receivable. This is very similar to the relationship of long-term asset and accumulated depreciation. Remember that long-term asset has the historical cost of furniture and building, and accumulated depreciation has the part that we measure, the part of asset's value that is old, that's no longer useful. Here they have a very similar relationship compared to these two accounts to depreciation. Accounts receivable, you always have the part of the value that you expect to get from customer, from client on time. The total expected dollar amount that you'll be collecting in the future. The allowance account measures up the part that you expect you're not collecting. Okay, so these two at the end, when you represent it on balance sheet, you see this first, you see this recorded, the line below it, representing the part that we expect we're not getting. Okay, so this will be subtracted for receivable. Okay, let's take a look at the specific two different methods. We'll be talking about percent of sales first. So there are two ways to estimate uncollectibles. One is very straightforward, which is based the percentage on the total dollar amount of sales that we make to customer. And here the sales, we're only referring to the sales on credit, so not the cash sales, because cash sales readily are collected by cash immediately when that transaction happens. So percent of sales will be estimating a portion of uncollectibles based on the total sales that you made on accounts receivables. So meaning that if the total accounts receivables sales that you make this month, let's say were $20,000, and based on past experience, you may have 1% of these that the company would not collect from customer based on estimation. Then the total uncollectibles would be 1% of these, which is $200. The dollar amount later on that falls into the entry would be a percentage of estimated uncollectibles times the total credit sales. This is the first method, the core idea of this, percent of sales. We usually call this method also the income statement approach, just because sales revenue appears on income statement. We're basing estimation by sales revenue, so we call this income statement approach. Okay, another method here is called aging of accounts. Aging of accounts means that company would be categorizing accounts receivables by its age. So if earlier a transaction happened in January, then the age will be older than the transaction that happened in December, for example. Okay, so they will be slicing, categorizing accounts receivables, those subsidiary accounts as age. based on different categories, and they assume that the older the account gets, the more probability will be assigned to that account in terms of not collecting the money. Okay, so the older the accounts, the higher percentage, later on I will show a table, higher percentage of uncollectability will be assigning that dollar amount to that account. The younger the accounts receivables are, the less percentage, less probability that the accounts will not be collected because it's still a new account. So some companies uses just one method of these. Some companies may use a combination of these two methods. Percent of sales typically is used on a monthly basis for a lot of the corporations. And aging of accounts, usually companies, if they use a combine of the two, they will only do this at the end of the year. They summarize all the accounts, receivables accounts, slice them into their age, and then use the aging of accounts to estimate the part that they may not be able to collect. Okay, so some companies use this one, some companies use a combination of these two methods. All right, let's take a look at an example. So let's say that at the end of this year, after all the transactions that happens, at the end of this year, accounts receivable has a balance of $3,000. So notice this $3,000 is not really the total of all the sales that happened, because a part of these will be paid by customer in the middle of the year. Remember, the general cycle is only a month. So there should be a lot more transactions that happen within the year that has been constantly changing accounts receivables balance. But when it reaches the end of the year, now currently the balance is $3,000 on December 31st. Okay? I'm sorry, in August, at the end of August. And then there's an allowance for uncollectible accounts. Again, this is the contra account balance. Before we do the estimation, the balance is zero. Now let's say the company wants to issue a monthly statement, and they want to make sure that they measure up the part potentially will be uncollected later on. So this middle entry here, you see the bracket there, $15,000 is the total credit sales that the company made to their customer. Their sales that didn't collect cash immediately, altogether worth $15,000. And they estimate from prior year's experience that uncollectible may be 2% of those. Okay, so $15,000 times 2%, we estimate that $300 of balance would likely not be collected on time. We're having a delay payment. We're not collected at all later on. So this $300 will fall into the contra account. Accounts receivable will still have the original amount, but later on balance sheet you will see $3,000 listed first and then $300 listed right below it. So meaning the net realizable value is $2,700. This really is the accounts receivable that we really expect to get on time. Okay, this is the first method, percent of sales. We will add up throughout the year or throughout the month. If we want to do a monthly statement, we will just add up throughout the month what is the total credit sales. In this case, it's $15,000. Total credit sales, and then determine what is the percentage. So the percentage will be given to you in the problem. Okay, the percentage basically is based on prior experience. About 2% of the accounts receivable may not be actually received. So altogether, we expect there's a high likelihood that $300 of this accounts receivables will not be collected. So of the $3,000 accounts receivable, on balance sheet would also list $300 right below it. So overall, the value of accounts receivable that we expect to get on time is $2,700. Okay, by journalizing this entry, we'll be debiting uncollectible account expense. So we think of this as an expense of doing business by allowing customers to make the payment later. Okay, this is an expense that we journalize up front, just an expectation of uncollectibles. And at the same time, we'll be crediting allowances account. Again, this is a contra asset account, so it has normal balance on the credit side. So in the following month, let's say in September, if there were $200,000 of credit sales that made in September overall, and again, company wants to issue a monthly statement, they have to estimate at the end of this month, September 30th, they also want to estimate the part of uncollectibles for these $200,000 of sales that they made in that month. So again, they times the 2% again, and then journalize this entry. Uncollectible account expense, allowances for uncollectible accounts. Okay, let's work on an exercise problem here. This company says that they made sales revenue total of $322,000 on account, and it's based on prior year experience that the percentage of uncollectibles is 2% of those. December 31st, accounts receivables current balance at the end of the year is $36,000. Now, under percent of sales method, try to journalize sales entry and uncollectible account expense. And then at the end, what is the balance that you would see on balance sheets for accounts receivables? Okay, grab your pen, find a piece of paper. I want to see everybody doing this exercise. first entry here, how do we journalize sales? What do we debit? What do we credit then? We definitely have accounts receivable, so this is the credit sales. That's why we're doing accounts receivable and collectibles. And then the right-hand side, we're going to be crediting sales revenue. Okay? So remember, normally this is introduced in Chapter 5. Normally sales has two transactions, one also on cost of goods sold, one on inventory. And here this problem, for simplicity purposes, it didn't tell you what is cost of goods sold. It just submit this entry. Okay. Now this second entry here, so lower that down. Okay. Second entry, after sales, second entry, we want to estimate uncollectibles based on 2% of the total sales transaction, which is $322,000. We use $322,000 credit sales times 2% of uncollectibles expected amount. Okay, so this will give you $6,440. And we capture this estimation based on the two accounts there. Uncollectible account expense, you see this recorded at $6,440. And allowances for uncollectible accounts credited at $6,440.
Can you go back one? I'm sorry.
Go back to the problem side?
Yeah.
Sure.
Shouldn't you use 36,000 because that's the balance total?
$36,000 is the balance, meaning at the end, when it gets to December 31st, this balance here is just the balance on this time point, but it doesn't mean all throughout the year the total of accounts receivable. So the total of credit sales, this method here is called percent of sales, right? So we're using the total credit sales times 2%. But this here, early on, we must have had many different transactions, and some of them was paid off by clients, and then later on, this is the balance that's left. Okay, so you might have January, February, March transactions, and then some of the customers did pay on time, so you credit this. So this is the overall balance that's still left, and you'll be receiving payment next year. Okay? The percent of sales method, when we talked about this earlier, is that we're using the total dollar amount of sales that actually happened. So it's adding up all throughout 12 months, the total credit sales amount. Okay, so this transaction, this example here, you have this $3,000 balance there. That's the ending balance after some of the clients paid off their, made the payment for accounts receivables. So the $15,000 is the total credit sales amount. Okay, so we'll be doing the estimation based upon total amount of credit sales. Okay, keep in mind that accounts receivable balance will be constantly changing as some of the customer pays off their money. So for example, in January 1st transaction, oftentimes the majority of the customer will pay that money off before February kicks in. February's transaction, a lot of the clients will pay off the money before March. Okay, March, they'll pay it off before April. So this really oftentimes relates to only the November or December transactions. Okay, so this part when we do estimation, we're estimating a whole year of time, just in case. So just in case earlier there's some of the transaction, the customer really delayed the payment. Up to the point of December 31st, you still didn't receive the payment from them. So this is a total allowance pool. The estimation part that we do estimation based on the total sales transactions happened this year. Just to be on the safe side, we record it as uncollectibles before it actually is deemed as uncollectibles. And this also goes back to the conservatism principle, meaning that we never want to make allow creditors or investors to think we have too much of an asset or too much revenue, because that is very dangerous when later on that didn't turn out to be the actual case. So to be more conservative, or maybe think it's a little pessimistic, we always want to estimate the part of expenses and liability that will likely occur. So this is what this transaction means. Okay, so after this measurement here, at the end, when you would see on balance sheet, you would have accounts receivable listed $96,000, and you have have the contra account 6,440, it will be listed like this for accounts receivable section. At the end, you have a net realizable value of 29,560, which is really the amount that we're expecting to get on time. Okay, this part, we estimate a pool up front. Assume that this part may likely not be received. Any other questions so far? Right, so far we really just introduced one entry, the debit, uncollectible account expense, and credit allowances for uncollectible account. Okay, this is the first. Before this, we charge the customers that really has a payment that's due that they haven't actually paid on time. This is an estimation of allowances. So what we're doing next is, before talking about write-off, this is another method. The header is aging of accounts. Remember, we have two different methods of allowances. So percent of sales is one, based on the total credit sales. Aging methods is another way a corporation could estimate allowances. So you see this table here, the left-hand column, there's all the customers that have been dealing with transactions with this corporation. And we break that down, the accounts receivables, into different time periods of ages. So you have only a 1 month old accounts receivable accounts, 2 months old, 3 months, and more than 3 months. And here the critical part is that the percentage is assigned here. Okay, so in each and every problem you'll be given these percentages. You don't have to worry about memorizing these. So the percentages here basically gives you the possibility of not collecting the money on time for different ages. Different account ages, it's different. So the younger ones, we only assign 1% of likelihood of not collecting it, 2% for 2 months old accounts, 5% for 3 months old, and over 3 months, you may assign a very high percentage because it has been past due for more than 2 months. Okay, so there's a 90% here. Overall, what we're doing is the total amount of accounts receivables times these percentage to have a dollar amount of uncollectible balance, and then we add them up all together. Okay, so meaning that 1 month old of accounts receivable altogether worth $18,060 for multiple accounts that you just dealt with in this month. So the total percentage of uncollectibles we assume is $19. Okay. A 2 months old of accounts receivables, we assign 2% to it and assume that there is only $4 that we will not be collecting. So 2 to 3 months old, we assume there's $17, and over 3 months, we assume $360 of this $400 would likely not be collected. And we add up this last line here to get to a total balance $400. This is the target balance of allowances that we're looking for. Okay, this is the target balance of whatever was recorded there in prior year. We assume at the end of this year, it will be altogether $400. Remember, this is also a permanent account, so you will have a balance from last year already. So assuming last year's balance was just 100 for all the estimation that happened last year, this is this year's target balance. And we want to adjust the entry. Allowance is estimation entry for $300. The difference is between the two. Okay, once again, oftentimes companies use this aging methods at the end of the year, at the end of each year. So last year end, you have this exact same table, which is probably the client name is different, and the ages dollar amount is also different. But you do the same thing, as assign a percentage times the total balance of accounts receivables. So assuming last year end the balance is 100, and in this year, after this table of calculation, the balance is 400, then we want to measure the difference to $300, and again, journalize this entry. Uncollectible account expense, allowances for uncollectible accounts. Okay, so what you get at the end of this is the target balance of allowance account. And you calculate the differences between last year's balance and this year's new balance. So $300 is the part that we want to additionally estimate for this year. And so first step of this is really just to fill in customer's name, fill in the dollar amount of the transaction that you dealt with them in different entries, and categorize them based on age. And companies will send percentages of uncollectibles to these different age of accounts, and we calculate a balance of uncollectibles based on those percentages, and then add them up, figure out a target balance for this year end. So this $400 is the total part that we're assuming we're not getting from all these customers on time. Okay, and then this $400 may not necessarily be the dollar amount that we want to journalize. We're just journalizing the differences between $4,400 and last year's ending balance. Okay, but if last year, let's say it's a new company, last year was 0, then 400 would be the total amount of investment. And if last year there was a balance, which likely there is, as long as the company has been operating well, then the difference is the amount that we want to journalize. Okay, let's take a look at the numbers here in the following slide. So here's an example that accounts receivable ending balance is $2,800. Using this aging of accounts method, last year's balance was $150. This year is $400. So the difference here is $250 between those $2 amount. That's the part that we want to journalize as additionally uncollectibles for this season, for this year. Okay, so the debit credit dollar amount is the same for both methods. For percent of sales, we're using credit sales times percentage. You debit credit these two accounts. For aging of accounts, the same journal entry. Debit account for collectible expenses, credit allowances. Just the dollar amount, how we arrive at the dollar amount is different. Okay, we want to make the adjustments. Last year end is 150. This year our target balance is 400. So we estimate an additional 250 here. So for these two methods, company can decide which one to use, but oftentimes corporations do a monthly basis estimation on percent of sales, and then at the end they do a whole table of that aging of accounts to match up. Additionally, is there other adjustments that they want to make? Okay, so oftentimes this occurs at the very end of the year. Percent of sales may happen frequently at the end of the month. But altogether, the purpose is the same. We want to estimate a pool of uncollectibles. So after this estimation, again, net realizable value, we're just using the 400, subtracting it from accounts receivable. So just like earlier, allowances, any dollar amount that appears here, subtract it from accounts receivable to figure out the net realizable value. Okay, so this part is the same as percent of sales. Meaning altogether, we're expecting to collect $2,400 of accounts receivables on time from all the customers. Okay, I'm going to skip this for now. I want to get to what happens after this estimation. So after this estimation here, when it gets to next year, the beginning of January 2015, earlier the example was 2014. When it gets to next year, after several attempts of trying to pursue some of the payments that is past due from customer, to a point of time, corporation would decide which are the customers that are considered uncollectible accounts receivables customers. Okay, so for this example, they already know that Andrews and Jones accounts receivables payments are not collected on time, and they have been constantly trying to get the payment from them. To a point of time, corporation, usually a few weeks later, they may turn this case to just financial debt collection company or attorneys to keep track of these cases. But at the same time, when they transfer these cases, they would do this write-off entry for uncollectible accounts. Okay, this write-off entry here, to see that accounts receivable is being reduced for these two customers, allowances account is being used. So that allowance pool that we estimated earlier, the $300 or $400 earlier, would now be used to assign to specific customers that actually are deemed as uncollectible bad debt customers. Okay, so this is not saying that they don't have the responsibility to make the payment. We're just trying to match up what happens in reality with the statements. So, meaning we don't want to overstate the accounts receivable when in reality these two customers' payment is readily past due. We reduce it first, write it off first, but later when we collect it from those customers again, even if it's a delayed payment, we'll reverse this entry later on. Okay, but a few weeks later, after the accounts are past due, oftentimes company, when they transfer these cases to attorneys or debt collection company, they would do this write-off entry first, just temporarily reducing accounts receivables for the clients that has past due payments. Okay, so whatever was the pool that we used to earlier estimate allowances for uncollectible accounts, now we will be reducing a certain dollar amount by the actual bad debt customers. So we're using this pool, assign it to the accounts receivable, and reducing accounts receivables. Okay, so after this journal entry, if some of the customers, they now have enough cash on hand, they want to make this payment, even though it's a delayed payment, we'll still be recovering this journal entry and collect the cash from them. Okay, so this entry happens when we have constantly been pursuing this payment, but the corporation didn't get it successfully. They write it off first. Later on, when they receive the payment from Andrews or Jones, they will reverse that previous entry and then journalize a regular cash collection entry for accounts receivables account. Okay, you may think, so if this happens later on, why do we have to do that write-off entry beforehand? So we do that write-off entry beforehand because we don't want to overstate accounts receivables. But keep in mind that anything reported here would seem to outsiders as a definite collection later on. So they will be expecting to see some cash later on collected for $36,000. But if a part of these are past due already, and you know there's a high likelihood that you'll not be collecting from some of the customers, we usually do the write-off entry first, just so that the corporation is not overstating accounts receivables. Okay, but after this write-off entry, it's possible that some of the clients have enough cash and do the late payment, for example, a few months later, March 4th, then you just reverse the earlier entry
increasing the balance of accounts receivables back to its normal balance, the $80 for that client, reducing allowances account, and then the regular cash collection entry. So altogether today, really there's three main entries. One is doing an estimation up front before any customers are deemed as bad debt clients. Second, when you realize some of the past due accounts you're not able to successfully collect it, we'll be using this allowance of uncollectible accounts and then reduce the specific clients. That's the second entry, the write-off entry. Third, if the company has delayed payments from these entries that are these accounts that earlier was deemed as uncollectibles, they just simply flip this previous entry. So bring back the accounts receivable balance first. And then the fourth entry is a regular cash collection non-account entry. And one is estimation, one is writing off bad debt clients. Third one is reversing it if clients pay back the money. Fourth one, regular cash collection entry.